All right, here's a thought. It might even get us kicked out of a traditional finance seminar.
Oh, I like where this is going.
You know the absolute golden rule of investing, the one everyone from your grandfather to your bank manager, swears by, buy and hold forever.
It's the first commandment of the market, for sure.
Right. But what if? What if that commandment is actually a trap?
It's a provocative idea.
Yeah.
I mean, it goes against everything we're taught.
Totally.
But if you look at the actual mechanics of how money moves, not what people say, but what they do, questioning buy and hold, is probably the first step to actually keeping your wealth.
That's exactly what we're digging into today. We're looking at some really challenging insights from a source called Mr. Brain that just completely dismantles this almost religious devotion to holding stocks forever. We're going to look at why never sell is, well, a dangerous myth, why dollar cost averaging can sometimes be financial suicide, and why the financial elites preach patience while they are frantically hitting the sell button.
And this isn't just about trying to time the market, which, we all know is hard. This is about understanding the incentives of the food chain.
Right.
We need to talk about why the experts go silent right when you should be selling, the psychological tricks that keep us all trapped in losing positions. And ultimately, we need to build a framework for knowing when to just say enough is enough and walk away.
But before we get to the exit strategy, you need a thermometer. You really do. You need to know if the room is on fire before you run for the door.
That's a great way to put it.
Knowing when the market is overheating is just crucial for these decisions. So, to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
It's a great tool. It really helps keep you grounded when everyone else is getting, euphoric.
Absolutely. And for our listeners tuning in who want that bilingual edge, hit Apple Store, Joe Buffett Indicator.
So let's get into the meat of this. Why is buy and hold the only message we ever seem to hear?
Yeah, let's start with what the source calls a conspiracy of silence. It sounds a bit ominous.
It does.
It argues the financial industry is essentially this closed ecosystem and interest community, but that sounds a little polite to me. It's more like a feeding trough, isn't it?
I'd call it the financial food chain. You've got the investment banks, the mutual funds, the exchanges, the brokerages. They all look different, but they all eat the same thing. Fees, management fees, trading commissions, you name it. And most of those fees are based on assets under management, AUM.
Right.
Their entire business model relies on your money staying inside the casino.
Okay, hold on. Let me play devil's advocate for a second. Is this really a conspiracy, or is it just that these funds, believe in their product? I mean, telling people to stay invested is generally good advice historically, isn't it?
It is.
It feels a bit cynical to say they just want our fees.
It is cynical, but look at the incentives. What happens if a big fund manager goes on TV and says, look, the market is way overheated, everyone should sell and just sit in cash for 6 months? What happens to his business?
His investors pull their money out. Instantly.
And he loses his management fee, he starves. The whole industry can't survive a mass exit to cash. So that narrative, the long-term holding story, it isn't just investment advice.
It's a survival mechanism for them.
Exactly. They need the table full of chips just to keep the game running.
So even if they know a crash is coming, they can't. They can't really tell you to leave.
They can't. And that leads to the darker side of this whole equation, the liquidity trap. The source makes a really brutal point here. Never sell is a sermon preached to retail investors, the sheep, to make sure there's someone to buy when the smart money needs to get out.
This part really stuck with me. The source brought up a story about Warren Buffett that I honestly had never heard before. It's about his exit from PetroChina back in 2007.
Oh, this is a classic heist movie moment in finance. It illustrates the problem perfectly.
Okay.
So Buffett wanted to sell his massive stake in PetroChina. He knew the price was too high, but he had a huge problem. He was just too big.
If he hits sell on his computer, the market sees that huge volume and
It panics.
Yes.
Instantly, the price crashes and he completely destroys his own exit.
Right.
He needed to get out before the market even knew he was leaving. So, you know what he did?
What?
He used snail mail.
Snail mail. No, in 2007.
Yes. He physically mailed his disclosure documents to the Hong Kong exchange. He knew that the mail would take a few days to get from the U.S. to Hong Kong.
Wow. That is devious.
It's brilliant. He used that physical time lag to buy himself a window. While those letters were sitting in a mailbag somewhere over the Pacific, he was aggressively selling his stock.
Oh my God.
By the time the letter finally arrived and the public found out Buffett is selling, it was already gone.
So while all the retail investors were reading reports about holding for the long term, Buffett was using the Postal Service to front-run them.
It highlights the harsh reality of liquidity. You can't sell if there's no one to buy, If the elites want to escape, they need the public to be buying.
And the buy and hold story keeps them buying.
It ensures the liquidity is there for them.
That makes me feel a little less like a disciplined investor and a little more like the bag holder. But surely the analysts, the pundits on TV, someone sees a crash coming, why doesn't anyone warn us?
Well, this brings us to the asymmetry of reputation. Imagine you're a famous analyst, right?
Okay.
If you predict a boom, you say the market's going to the moon, and you're wrong, what happens?
People lose money, but everyone was optimistic. It's forgivable.
Exactly. Optimism is socially acceptable.
Yeah.
But what if you predict a crash? If you're the bear?
You're the party pooper.
It's worse than that. If you predict a crash and you're wrong, you are mocked. I mean, look at how people treated Buffett when he avoided the dot-com bubble or Bitcoin. They called him a dinosaur. They laughed at him.
That's true.
Now, here's the kicker. If you predict a crash, and you're right, you get blamed for ruining the party. You become the villain who talked down the market.
So you literally can't win.
You can't. So the rational choice for a public figure, for their career, is to stay optimistically vague. You hear things like Howard Marks saying, nobody knows. It's just safer for your reputation to be wrong with the crowd than to be right all by yourself.
That is a fascinating psychological trap for the experts. But let's look at our own psychology. Because even if I know all this, even if I know the game is rigged, I still find it incredibly hard to hit that sell button.
That is because your own brain is fighting you. We have to talk about loss aversion.
The idea that we hate losing way more than we love winning.
Much more. And here's the trick our brains play. As long as you don't sell, that loss feels fake.
Right.
It's just a paper loss. You can look at the screen and just say, oh, it'll come back.
Right. I haven't actually lost any money until I sell. I've definitely said that to myself.
We all have.
Yeah.
But the moment you sell, the pain becomes real.
Yeah.
You have to admit failure. So never sell becomes this psychological shield. It protects your ego from admitting you made a mistake.
It also feels like there's a bit of an identity crisis involved. Like if I buy a stock because I think I'm smart and then it drops 30%.
Then you have cognitive dissonance. The reality, which is you're losing money, conflicts with your self-image, which is, I am a smart investor. So you rationalize, you pivot, you say, oh, I'm not a trader, I'm a long-term investor. You just rebrand being trapped as having a strategy.
Oh, that hits a little too close to home. I think we've all done that. I believe in the long-term vision of the company. Usually just means I am down 40% and I'm scared to exit.
And the internet has basically weaponized this. Just look at the whole diamond hands culture.
The memes, HODL.
It's tribalism. In these online communities, selling is framed as a moral failing. It's a betrayal of the tribe.
Right.
If you sell, you have paper hands. You're weak.
It's peer pressure, but for finance.
Precisely. It feels safer to lose money with your friends than to make a rational exit alone and risk being kicked out of the group.
So we have the industry working against us, and our own brains are working against us. But I want to go back to the logic of buy and hold. Because surely, over a long enough timeline, the market always goes up. The source calls this the linear history fallacy.
This is one of the most dangerous assumptions we make. We assume the stock market is like physics. You know, gravity pulls it down, elasticity brings it back up. But the market isn't physics. It's a political and social construct. And those can break.
The source used a pretty chilling example to illustrate this. The Shanghai Stock Exchange.
Right. Picture Shanghai in the 1940s. It was the Wall Street of the East. Bustling, massive wealth, huge companies. If you were a buy and hold investor there, you felt invincible.
And then 1949 happens.
The regime changed. The exchange closed. And it didn't just close for a week. It stayed closed for over 40 years.
Oh, so if you held for forever.
You went to zero. The paper became worthless. When the exchange finally reopened, decades later, it was a completely new board. Your old equity was gone.
Wow. That's a stark reminder. We get so used to the stability of something like the S&P 500 that we forget. Regimes change, currencies fail, and markets can actually just disappear.
Exactly. Assuming it always comes back shows a kind of lack of respect for history. Survival is not guaranteed.
Okay, so we've dismantled the myth. Buy and hold can be a trap. The pros are selling while telling us to hold. Our brains are tricking us. So what do we actually do? We can't just panic, sell everything.
No, panic is just as bad as blind faith. The source outlines what it calls a rational selling framework. It's basically a synthesis of the actual behavior of guys like Buffett, Munger, and Lynch. It's a decision tree.
Let's break this down. It starts with a simple question. Has the core logic changed?
This is the fundamental check. Why did you buy the stock in the first place? Did it have a moat? Was the management brilliant? If the moat dries up, say a competitor releases a better technology, or if the management turns out to be corrupt. You sell.
Immediately. So no waiting for it to bounce back.
No hoping. Hope is not a strategy. If the thesis breaks, the investment breaks. You're done.
Okay, that's clear. Step 2 deals with the price. Is the valuation extreme?
This is where we avoid the bubble trap. Even a great company can be a bad investment if you pay too much for it.
Right.
The source suggests using the PEG ratio, price to earnings growth.
Can you unpack that for us? What are we looking for there?
Sure. You're essentially asking, how much am I paying for future growth? If the PE ratio is really high, but the growth is low, that PEG number shoots up. If the PEG is widely over, say 2, or if the valuation has just completely disconnected from reality, you are walking on very thin ice.
So if the chart looks like a vertical line, it might be time to trim.
You trim or you sell to lock in profits. Like the source says, money is only real when you sell. Until then, it's just digital ink. You don't want to be the person who rides a winner all the way up and then all the way back down again.
And the final point in the framework is my favorite because it feels the most empowering. Opportunity cost.
The switch. This is the huge mindset shift. We tend to get married to our stocks.
Totally.
But investing is a comparison game. You should always be asking yourself, is my money working as hard as it possibly can right now?
So if I'm holding stock A and it's doing okay, but over here, stock B is cheaper, safer, and growing faster,
then selling stock A to buy stock B isn't giving up. It's an upgrade. You are optimizing your capital.
I love that.
The never sell crowd views selling as a failure. But a rational investor views their selling as a tool to move capital to a better home.
Selling isn't an ending, it's a transition.
Exactly. It puts you back in the driver's seat.
To wrap this all up, the source ends with a metaphor that I think just perfectly captures this whole philosophy. It references the sci-fi novel The Three-Body Problem.
Yes, specifically the story of the starship Blue Space. It's a pretty grim but powerful analogy.
For those who haven't read it, the ship is trapped in deep space, and it's facing a battle they can't possibly win with normal tactics.
Right. So to survive, the crew has to make this horrifying choice. They have to drain the atmosphere from the ship to prepare for a high-G battle in a vacuum. They essentially have to shed their earthly environment, the very air they breathe, to survive the void.
And the connection to investing is?
The market is a dark forest. It can be hostile. And to survive it, you sometimes have to shed your earthly morality. You have to shed the media narratives, the tribal loyalty to a subreddit, the fear of judgment from your peers. You had to become a cold, rational actor.
That gives me chills. It's about stripping away all the noise and just doing what is necessary to survive.
The ultimate right of any investor is the right to exit. It's your vote. You vote with your feet. Don't let a slogan like Diamond Hands take that vote away from you.
That is a powerful place to leave it. Remember, the sell button is there for a reason. Use it when the logic dictates.
Stay rational.
Now, before we sign off, we do need to cover the important legal and community details.
Yes, listen closely. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
And if you want to listen to our full deep dive about this topic or access more advanced content, welcome to join the Deep Value Club membership or subscribe to us on Apple, Spotify Podcasts channel, Deep Value Investing, and luluvc.com.
And for our global friends. 说真的，书下后啊，也是我很少因特sản được của một đặc quyền. 书上公约的取查公约đặc quyền, bảo anh hát chia sẻ, ý số mà chào đã. 书上只讲我上网这个下过啦，上上古他公忙下公的，上包括年不红吃干呢。上中上，小三古公益大户，一上三公和公我去放社交。公益好好不给我，身上不清的不放的货，希望在家喽。想到上公益都很，为新出家都困有啊。
想不听我看佛好，五百五毛，商务想不为，扶手上出在有帮助之块，新多顾看，身上困受掌控，想操控他货。